Hello, everyone. It is great to be back with you on Tuesday, January 13th. We have had a ton of news in regards to mortgage interest rates and the mortgage market as a whole, so we are going to jump right in. We're going to start here as we do every single meeting with a chart of mortgage-backed securities. The big news here came last Thursday when President Trump announced via Twitter or X that he's instructed Fannie Mae and Freddie Mac to buy $200 billion of conventional mortgage bonds. What that does is kind of similar to what happened during COVID. Artificial demand for mortgage-backed securities drives mortgage-backed security prices higher and drives mortgage interest rates lower. And that's what you saw on Friday when every realtor under the sun posted about 5.99% interest rates. What they don't post about oftentimes is that since then, we've seen some profit taking in the bond market. Really, as a reminder, mortgage bonds are an asset to bond traders out there. So when they see these big spike ups in mortgage-backed security prices, oftentimes you see a little bit of a correction, and that right here is generally due to profit taking. The good news here is that this move all the way back or from yesterday is the lowest we've seen interest rates basically for the past 2 years. That's really positive news for the psyche of home buyers in general. Well, it'll be curious to see if we can maintain these low levels of interest rates moving forward. And as I'll cover in a moment, I think we've got good reason to believe that we can do that. Okay, here again is the chart of mortgage interest rates. If we look all the way back to just 1 year ago, we saw interest rates over 7%. And the good news here is that interest rates are in that low 6% range now, creeping just below 6% last Friday for just a moment there. What is driving mortgage interest rates? Let's talk a little bit about fact or fiction or bluster or bolster. Okay. What is driving mortgage interest rate is this 200 mortgage bond buying program. Again, I talked about it earlier. What you're seeing here is the artificial demand for mortgage-backed securities, which will push interest rates lower. Lower for how long? It's really hard to say. They haven't really specified in terms of how often how are they going to be doling out this $200 billion mortgage bond buying program, and the duration that they expect this to last. Banning institutional investors. Is this going to help the average Joe Schmo buyer? Probably not. Last year, institutional investors, which is classified as buyers who own more than 100 properties, made up about 1% of transactions. So is the buyer that you're representing going up against an institutional investor on a given day? More than likely not really. The DOJ Fed probe. We saw over the weekend that Jerome Powell came out and announced that the Department of Justice is not quite ready to indict Jerome Powell, but they are investigating Jerome Powell. Again, I don't know that this is really going to move the market on mortgage interest rates as a whole. Okay. And then those last two there, again, it's really hard to see whether or not these are going to be meaningful movers when it comes to mortgage interest rates. Okay. Let's take a look at what economic news actually does move mortgage interest rates and what we pay attention to each and every week. And it's really what I report to you every week. So what we got last week was a lot of information around the BLS report or the Bureau of Labor Statistics and the ADP jobs report. The interesting one here was on the BLS report, that unemployment rate moved lower from 4.5% down to 4.4%. But the big headline news here was the November and October reports. Those job reports had a cumulative revision of 76,000 jobs removed or revised lower. And so really that was the big takeaway. Yes, the unemployment rate moved lower, which is not necessarily a good news for mortgage interest rates, but it was these these revisions from previous reports, that really saved the day there. Okay. What we are seeing in the inflation report is a 0.3 month over month for CPI, which really was stable for a 2.7 year over year rate of inflation. Okay, what all this means here is ultimately it was a pretty stable week or so of news, and this is the news that the Federal Reserve is going to utilize for when they make their decision later on this month on whether or not they are going to cut interest rates. And right now, if you're looking at just these 2 weeks, this 2 week of news, you're seeing weaker jobs data and you're seeing more stable inflation, which is what the Federal Reserve wants to see when they are thinking about cutting the federal funds rate. Okay. We still have a handful of big reports that are coming up later on this month that is going to play into the opinion of the Federal Reserve on whether or not they think they can cut the federal funds rate. But all signs are pointing to another Fed rate cut here at the end of January. As always, if you have questions for us, don't hesitate to reach out. My information is here. My business partner's information is there as well. I didn't get to everything I wanted to cover today. So if you have questions, don't hesitate to reach out, and I'll see you next week at the next office meeting.